Good morning, everyone, and welcome back to our weekly webinar series. Today, we are celebrating, or of course, we are having our 99th webinar, and the subject is a very important one where we're talking about the recent judicial pronouncement on Section 66, which are again a game changer with respect to what the resolution professional is required to do with respect to treating Section 66 applications and making those transactions available to the NCLT. Over to Anil, sir.
Thank you, Ankit, and welcome to 99th episode of AAA Weekly Webinar Series. We are eagerly waiting for 100th webinar every week without any gap. So we are excited, as you all are. The subject today is to, because see, this Section 66 is very, very important these days. Most of the applications filed by the RPs or liquidators are getting listed, are being pleaded nowadays. So therefore, this kind of clarity was required. So it was a thoughtful, the demand also from the audience that this analysis should be done. So we will go through the provisions first, and then there are many judgments. Those actually have come from NCLAT and also NCLT, various benches. One thing that I would like to say while going through all these judgments, that it all depends upon the way the transaction is understood by the transactional auditor, the way it is reported by the RP to the adjudicating authority, the way it is pleaded before the adjudicating authority, and finally the way the bench is understanding the transaction. So there is an overlapping in most of the cases, overlapping between Section 49, and also there are two sections of Section 66 also, Section 66 subsection 1 and Section 66 subsection 2. Both are entirely different, and in both the cases, the order would be different. However, in case the Section 49 is invoked where there is no look-back period, and also in Section 66 where there is no look-back period, therefore there is a difference in fraudulent intent when a property of the company is transferred to someone. So that actually should be covered in 49, but then I have seen some of the judgments where maybe it has not been properly pleaded that when the property is transferred to someone with a fraudulent intent and without any consideration, or so that actually should be considered under Section 49. So that is like various. So what I'm trying to say is it depends upon four things: how the transaction is understood by the transactional auditor, it is maybe for repeating, and how the transaction is reported, how it has been pleaded, and how the bench have understood it. The Supreme Court has not yet taken a very big call on this Section 66 issue, because hardly there is only one judgment where the 66 issue has actually been considered, other than the Anuj Jain judgment, where it was an overall collective judgment. So it was the collective order for Section 43, 45, 49, 50, and 66. Two things are very, very important that we actually can say. The 49, Section 49, and for Section 66, there is no look-back period. The only, for the purpose of Section 66, subsection 2, there is a concept of twilight zone. That we will explain what is the concept of twilight zone. But then, coming back to the basics of sections, so we actually would like to go through that. This is one scenario when we go to Section 66, subsection 1. It only says that if the business of the corporate debtor has been carried on with the intent to defraud creditors of the corporate debtor or for any fraudulent purposes. So when we call it defrauding the creditors, so defrauding the creditors means the assets which otherwise belongs to them, those assets, working capital, funds of the company, property of the company, in case all this is getting siphoned off, transferred without any business. So in case it is a business, it is absolutely fine. In case something has happened which is not business, the money is transferred to someone, so it is siphoned out to related parties. It is siphoned out to other entities which are again related party or unrelated party, but that is not business. So that actually shows that the business of the corporate debtor has been carried on with the intent to defraud the creditors. Now, when we say business, it doesn't mean that we have to do some trading transaction. Even when I transfer some money from my bank account, that is also business. When I'm transferring an asset from the company to any other entity, that is also the business. But the business is being conducted. If it is for the real business purposes, then it is okay. If it is not the business purpose, if it is not for the purpose of any benefit to the corporate debtor or for the purpose of the business of the company, then it is a fraud. That means that the intent is to keep that asset, keep that money, keep that property away from the creditors. That means defrauding the creditors or for any fraudulent purposes. So this is section 1. However, in this section 1, there is no there is nothing like twilight zone. So, but then this particular section says one thing, that if it is seen, if it is proved that the business of the corporate debtor has been carried on with the intent to defraud the creditors, then any person who were knowingly parties to carry on the business in such manner shall be liable to make such contributions to the assets of the corporate debtor as it deems fit. Now, section 66(1) is only, it is basically for any person. So the adjudicating authority can pass an order against any person, and that may include promoters, that may include directors, and that may include even a CFO or CEO or any other person who actually has known and that it is being conducted fraudulently. Maybe a transferee where the money has actually gone there, where in case some assets have been transferred there. Those parties also have to become, because see, the other party will also know that some money or some asset is getting transferred to me, that too without any consideration. That means that that particular party is also knowingly becoming party to this fraud. So therefore, section 66 subsection 1, where the order can be passed by the adjudicating authority, and that can be against any person, including the promoters, directors, CFO, CEO, or any other person, even transferees. Now coming to section 66 subsection 2, where it is saying the adjudicating authority can it basically can pass an order and direct a director or a partner in the case of LLP. They shall be liable to such contributions to the assets of the corporate debtor. But there are two conditions. In these two conditions, if before the insolvency commencement date, such director or partner knew or ought to have known that there was no reasonable prospect of avoiding the commencement of corporate insolvency resolution process in respect of such corporate debtor. One, that there should be a belief, the director or the partner in case of LLP have this belief, ought to have known that there is no reasonable prospects of avoiding CIRP, and such director or partner did not exercise due diligence in minimizing the potential loss to the creditors of the corporate debtor. Now, when we say potential loss to the creditors, that means in case the mortgaged property, in case the property of the company where the rights of the creditors are already there, if that property is actually it's being misused and it is being transferred without any consideration, without any due diligence, some transactions are happening. So with the credit is being extended without due diligence, and that credit is not recoverable. Credit is being extended to fake parties. Material is being sold to fake parties. So that means that the material is going out of the company, but the money is not recoverable. That means he did not exercise the due diligence in minimizing the potential loss. So this is where the order can only be passed only against the directors or partners in case of LLP. So these are the two separate sections, and there are two separate kind of orders would be passed in these cases. My understanding is that most of the transactions are overlapping, where the intent to defraud the creditors will also be found, and also the directors or the promoters would out to have believed that this company is going to go to ECIRP. So they actually will do some kind of transactions which are without any due diligence. So therefore, the application from under section 66 subsection 1 and application under section 66 subsection 2 should be a combined application. I'm not suggesting that there should be two separate applications. However, if it is overlapping with the section 49, that also can go along, because in case we see section 49, that also, so first of all, in section 49 also deliberation is due, that deliberately a transaction must happen. But in section 49, the one condition is that there are these two conditions must be fulfilled in case we are trying to cover. One, that makes a gift to a person. Makes a gift to a person is not something as we see in the Income Tax Act, that the gift has to be accepted by the other party. Makes a gift to a person that some property has been transferred to another person, but then without consideration. That is a gift in the case of section 66. It is not something which is gift, which is with a natural love and affection, which is normally seen in the income tax. Now, in this case, again, the second condition is that there must be a transaction of transfer of a property at a price which is significantly lower than the price which otherwise this property or asset must have fetched. So these two conditions would be fulfilled, then only section 49 comes, because that particular transfer, that particular gift, that particular was basically, the intent was deliberately to defraud the creditors and also to keep the asset of the company away. Now, in this section 49, what is the sentence written? It is written, for keeping assets of the corporate debtor beyond the reach of any person who is entitled to make a claim against the corporate debtor. Who is entitled to make a claim against the corporate debtor is the creditor. So they basically to keep the assets of the company away from the creditors, or in order to adversely affect the interests of such person, basically the creditor's interest would be adversely impacted. So section 49 and 66, only difference is that while we are applying section 49, there has to be a transfer of property to someone, transfer of asset, transfer of money. That has to be transferred to another person. Maybe without consideration, it will be considered as a gift. With consideration, it will be considered as undervalued transaction. But one significant thing that out of our research came out, that section 67, which is following section 66, says that in case such findings are there, that there is some order is passed under section 1 or section 2, and then in that case, it is also possible. Now, for example, an order under section 66.1 or 66.2 has actually been passed, and to my understanding, like overlapping order for section 49 and 66 is also passed. Then in that case, if the contributories, maybe director, maybe related parties, maybe partners of an LLP, if there is an order to contribute on them, then in case they have some, the company owes some money to them. In case the corporate debtor owes some money to them and they have a claim on that company, then in that case, there will be the court can also say that there is a lien on that particular property. That is something which is provided in section 67. So what I say that under section 67, in fact, whenever there is a claim from any related party or any promoters, and there is any amount payable to them in liquidation, the application can be filed before the adjudicating authority under section 67, that such disbursement may be kept in abeyance till the time the disposal of avoidance transaction is concluded. So that kind of application can be made, that the disbursement will not happen to related parties, or disbursement will not happen to promoters or partners So that is what is provided in section 67. However, maybe an application would be required before the NCLT, before the order is passed under section 66, 1 or 2. So this is also another significant finding. So now in case, Ankit, can we go to the judgments, or we should have some questions?
I think we should go to the judgments, talk about those judgments. The questions that are here, I believe we can answer them through those judgments and also then take up the remaining ones later.
So they see, other than Anuj Jain judgment, which probably many people know because that's a combined judgment on avoidance transaction where it has been basically various transactions are held, like some of the parameters are defined. Then it is also directed to the RPs and the liquidator to file separate applications because of the separate evidence is required and separate orders are required. So those kind of scenarios are already there. But then there is judgment, one judgment which is there, the mismatch of stock, and that's what is there in the transaction. In fact, was like this. It was an honorable Supreme Court transaction. I will just say the transaction was the mismatch in stock reported and inventory arising from it from a time immediately preceding an application under Section 10 of the IBC held to be fraudulent. Now, this is a judgment from Honorable Supreme Court on 25th of March 22, and the citation of the judgment is Punjab Pakistan Swaminathan and others versus R. Raghavendra. The judgment is dated 25th of March 2022, and this judgment says then in fact in this case the some stock which was alleged to have been purchased or manufactured did not match with the sale made and the inventory remaining with the corporate debtor. In this case, the NCLT held that the transactions are supposed to be fraudulent in nature under Section 66. And then this was upheld by NCLAT also. And the apex court, like the Supreme Court, also found that the conduct of the corporate debtor was fraudulent in this case. Although a brief judgment, but yes, it was also upheld by Honorable Supreme Court. The judgments which are coming from NCLAT and that those kind of judgments is like one judgment that I would say Mrs. Planiamal and two others versus Ravati S. Raghunathan, who is the RP, and this is the NCLT, and this is the NCLT Chennai. Now, in this case, the transaction was when the forensic audit report was seen, it was found that the promoters of the corporate debtor withdrew money from the account of the bank account. However, the promoters contended that the money was withdrawn and the same can be treated only as loan and advances made in ordinary course of business. Now, if the money is withdrawn from the company and it can be considered as loans and advances, so the NCLT held as fraudulent, and NCLAT also held that in the absence of any evidence. However, the NCLAT said that in the absence of any evidence that the amount withdrawn for the appellant was advanced as a loan, the submissions made by the appellant cannot be accepted as it would be a bald assertion only. So therefore, this transaction was considered as upheld. So my understanding about this is about the loans and advances, because there are many such cases. Even we have filed many such cases where the loans and advances have been given to other entities. And as a chartered accountant, we know that there is a market for fake entries. So then you can actually give them check and the cash can come back. But apparently evidences are not there that there has been any cash transaction. However, in the books of account, it is always shown that the money is recoverable from ABC. Now, in case the auditors report that the ABC, whatever ABC companies are, those companies' KYC are not available, those companies seems to be fraudulent, those companies have been reported by any authority as fake companies. Therefore, in that case, we can definitely say that the director or the partners of the company are actually giving some kind of loans to those companies, those parties there where the KYC is also not there. So that is, of course, Section 66 subsection 2 would be covered. So even if it is said it is a loans and advances, because in one of my order, the bench says that if it is the sale of material and if the money is recoverable and if the money is not being recovered, it is how it is possible that it is a fraud. So like what we wanted to say, that the stock was sold to parties, fake parties. Those fake parties' addresses are not available. Those fake parties' KYC is not available. And those fake parties who took the stock, they didn't pay back. They didn't pay any money back to us. So in that case, if the money is recoverable, then it will not be a fraud. Definitely, again, it covers in the Section 66 subsection 2, because then the directors or the partners of the company, they have not exercised due diligence. They have given money to the parties who are not credit worthy. They have given credit on sale of stock to those parties whose credit worthiness is doubtful, whose existence is doubtful, who are considered as fake or benami. So all these considerations should be considered while we say that the loans and giving loans and deposits are not fraud. But the loans and deposits for the purpose of any business of the company, that is which is a business transaction. Loans and businesses without any purpose, without any business of the company, that is fraudulent, because that is having the intent of defrauding the creditors. So therefore, the loans and advances also should be considered as the transactions which are fraudulent. Now, the another case is Ashik Punam Parimphat versus Vibin Vincent, the liquidator. Vibin Vincent is an associate partner of AAA Insolvency, and this case was decided by NCLAT Chennai, because in this case the money was withdrawn from the corporate debtors bank account in the name of commercial decision, and using the same for personal benefits is held to be fraudulent in the nature. Now, the promoters in fact withdrew certain amount from the bank and invested the same in another company to obtain shares in the personal capacity. So that is, of course, apparently it is a fraudulent transaction. This knows the siphoning of the money and the keeping the funds away from the creditors, impacting the interest of the creditors. So that is something which is fraudulent. So this NCLAT also says that it is a fraudulent transaction because this was for the personal benefit of the promoters. So the next NCLAT judgment that I would be reporting is in the case of Randhir Singh Tomar versus Sunil Kumar Agarwal, the liquidator of YS Merchandise International Private Limited. Randhir Singh Tomar versus Sunil Kumar Agarwal, liquidator YS Merchandise International Private Limited. The judgment is dated 12th of December 2022. In this case, excessive commission was paid to a related party to let the corporate debtor function in the changed business environment does not attract Section 66. Now, in this case, what happened? This came from the principal bench, New Delhi. The corporate debtor increased the commission payable to a related party from 5% to 20% and further transferred assets at a loss in comparison to its book value just before filing the application under Section 10. NCLT held that the transaction is fraudulent. However, NCLAT, the principal bench, held that this was done in the normal course of business to let the corporate debtor function in the changed business environment. Such an arrangement, even though with a related party, cannot be termed as preferential transaction done to defraud the creditors. So this was the observation of NCLAT in this case. So moving on to the next transaction, which is again NCLAT transaction, NCLAT report. This is in the case of T.S. Murali, the ex-director, versus liquidator of Helpline Hospitality Private Limited. The judgment is dated 18th of October 2022. So this is a unique case where the property was purchased in the name of the director. However, the loan was taken in the joint name of the director as well as the company. And when the default occurred, the entire claim came on the company. The property is in the name of the individual director. This was held that this is a benami transaction, this is a fraudulent transaction, and NCLAT also upheld that said decision. Next, because since we are discussing various transactions where the NCLT or NCLAT has held as fraudulent or not fraudulent, the total focus today is the fraudulent or not fraudulent. Then the next transaction is it is a judgment of Deepak Parasuram, the designated partner of Ingenuum Advisory Limited versus Sri Priya Kumar RP of Perfect International Fabricators Private Limited. This is a judgment from NCLAT, and the date of the judgment is 21st September 2021. And this particular judgment was also upheld by Supreme Court on 13th of November 2021. The judgment was like the transaction was like this. The substantial unjustified transfers were made to the directors of the corporate debtor in the name of ordinary course of business. NCLT held that the transfer of funds of the corporate debtor for a fraudulent purpose and further directed the directors to contribute the necessary amount back to the corporate debtor. It was basically substantial unjustified transfers. Now, in this case, the NCLAT also upheld and observed that the substantial unjustified transaction have been made to the directors of the corporate and further held that the same would constitute fraudulent under Section 66. So these are the judgments from NCLAT, means Appellate Authority, and now we are moving to the judgments, which are many transactions that we would report. And these are why we are reporting in very brief manner, that it is basically we have to cover the various transactions so that practically we know what transaction actually would be considered as fraudulent and what not. Now we go to the NCLT Delhi judgment. Bhupendra Agro Private Limited versus Shri Vardhaman Rice Mill Private Limited. The date of the judgment is 24th of March 2021. In this case, the plant and machinery sold below their book value right before the initiation of CIRP by way of book entries, where no physical transfer of such assets took place. In this case, it was also considered as fraudulent. Fixed assets transfer. The fixed assets were transferred, and it was transferred only by book entries. Therefore, and it was well aware by the promoters that the application has been filed and it is pending initiation of CIRP. Therefore, deliberately, this particular transaction was entered into. It was undervalued to defraud the creditors by keeping the fixed assets away from the reach of the creditors. Basically, it should be a transaction under Section 49, but somehow it has been adjudged as 66. The next transaction is in the case of Argus Global Logistics Private Limited versus Nitin Baral. And this transaction is dated 21st of January 2022. Namesake resignation from the directorship and baseless writing off or receivables in the corporate debtor held to be fraudulent under Section 66. So in this case, what happened is the promoter shareholders of the company transferred their entire shareholding to a related party entity and held the same retransferred at a later point in time, during which period the shareholders resigned from the directorship of the corporate debtor while remaining in the control of the bank account of the CD. In this case, the NCLT Delhi found that the conduct of the affair was fraudulent, and therefore it was observed that the debt are written off without any basis during such period. So one is the writing off of the receivables. Now, writing off of receivables is very common. In the case of writing off, now the judgments have actually been seen that in case there is a genuine sale and the money is not received for any reason, but the efforts were made and the parties were genuine, then it is not a fraud. However, in case the property of the company is transferred to fake parties and then the sold to fake parties, and then that money is not recoverable back, that means that it was actually sold or the money was transferred to dummy or those companies where there is no creditworthiness. Therefore, the amount would be considered as the fraudulent. Another order that we could see is the AC Goel Distributing Company Private Limited versus WebTech Packaging India Private Limited. The judgment is from NCLT Delhi. And in this case, the cash received by the promoters for selling property of corporate debtor held to be fraudulent under Section 66. So in this case, it was somehow established only partial consideration arising from the sale of the CD's property was disclosed and reflected in its accounts, and the remaining money from such sale were received in cash by the director of the corporate debtor. This was considered as fraudulent, and but then according to my understanding, there has to be some evidence that the money was received in cash. So, which is the detail that we have not seen. Another transaction is GV Ravi Kumar versus the other order is GV Ravi Kumar versus 𝐝𝐬𝐬𝐜𝐬𝐬𝐜𝐿, this is NCLT Chennai, and the transaction is transferring of money by director after declaration of moratorium passed in an application under Section 10 of the code held to be fraudulent and amendable to Section 66 of the code. Now the money is transferred or withdrawn after moratorium. After moratorium, the money is withdrawn. So my understanding is that this actually is contravention of moratorium, and the contravention of moratorium is not covered under Section 66. But however, this judgment says amenable to Section 66 and the recovery order was passed. This was also a Section 10 application. The recovery order was passed against the promoters because this was the money out of the account of the corporate debtor after the moratorium. The next transaction is Ashok Singh Rajaput versus HBN Foods Limited. This is again from NCLT New Delhi. The substantial cash withdrawals and unsubstantiated transfers to various entities held to be fraudulent under Section 66. So the promoters of the company made substantial cash withdrawals and unsubstantiated transfers to various companies without any basis or the benefit of the corporate debtor held to be 66. I have said that any property of the company, when I say property, that means the property is already defined, money, asset, stock, everything is considered property. If it is transferred to someone, maybe against an invoice or any loan or advances, and then that is not a normal, that is not an ordinary business of the company, but that is not for the business of the company, that actually would mean that it is a fraudulent transaction. And then we go to another order, which is State Bank of India versus Madhushala Drinks Private Limited, it is NCLT Kolkata. In this case, the promoters actually have shown and filed an FIR that there was a factory, there was a fire in the factory, and also there was a theft in the factory. Therefore, all the assets were spoiled. Therefore, they actually said that the stock, inventory, plant and machinery, and other items lying in the factory, except land and building, everything actually was basically either it was stolen or it was kind of destroyed in the fire. So the NCLT in this case held that we have seen the dubious conduct of the promoters, and the story of fire is not supported by evidences, and there is no insurance that also shows a clear lack of due diligence. Therefore, the tribunal considered that there is a probability and plausibility of defense. It is only a defense only to reject the application by RP. So therefore, it was held to be a fraudulent transaction. So what do you say, Ankit? Should we take up some questions now, or?
We should take some questions now. I
Yes.
think we have gone through a lot of judgments. So, Animesh Khandelwal ji, I'm starting from the recent questions. Animesh Khandelwal ji is asking that in some cases, the directors who had previously resigned, their dues have been shown as loan to the company. Will that be considered fraudulent? Unless and until I believe there is any money that is going to them in priority over maybe other dues, that might be considered as a fraudulent activity. But showing their dues as loans to the company, not sure if that can be said to be fraudulent. What is your opinion?
So, see, like what I say that one, that section 67 is very important.
Mm-hmm.
Section 67 says that if there are dues of uh, promoters or directors or any other person against whom an application is against whom an order is passed under section 66(1) or 2, then the section 67 says then the court can direct that all this money which is due to promoters or related parties, that will be considered as a contribution from them to the corporate debtor. And if there is any asset, that also asset would also be the lien or charge on the asset would be also considered. So using section 66, one, that we would say that this, first of all, the two questions that Animesh is asking. One, that the promoters resigned, directors resigned, and whatever money is payable to them is shown as loan to the company. That means they have also filed their claim in the company. So that means that it's like, no, if the liquidation value is due to them, that means there will be disbursement to them. So if there will be disbursement to them, so that can be kept under lien under section 67. Now, this transaction as such, resigning from the position of directors, this cannot be considered as the fraudulent transaction, because see, the creditors of the company are not impacted. They have resigned from the company and their money is now shown as loan to the company. Whatever money they had actually paid to the company, that is now shown as loan to the company. This is also not a fraudulent transaction. However, when we file an application and try to find out any other person who actually is knowingly a party to this fraudulent transaction, then in that case, we should also cover those promoters who are the shareholders, but they resigned from the directorship because they are the people who are having the ultimate control of the company with them. So they should be also uh, they should also be made as respondents in all the fraudulent transactions, because uh, they somehow uh, intentionally they resigned from the company to avoid such actions against them.
Okay. So next uh, we have uh, uh, we have Mr. Mandluk. He's asking whether advances granted to entities based on overvaluations, whether where relatives of managerial person managed will be treated as fraudulent transactions.
No, I think
So
overvaluation and advances are two different
yeah.
things.
So here we are saying that advances are given, and where I think the idea is that the advances are given, which is the advances are beyond the value of the assets or whatever the objective for which the advances are given, and it is given to relatives of the managerial personnel. So I think it can be easily covered into fraudulent transaction.
No, as I said, that giving an advance to any other person cannot be considered as fraudulent. We
Hmm.
have to add one, that this advance is not for the business of the company.
Hmm.
There is no business which is actually being conducted by just giving this advance. Second, we actually have to say that this advance is not now recoverable. It is not coming back, and these are the efforts made. So then in that case, we can say that when the advance was given, this company's net worth was a zero or negative. Then we can say that this company where the advance was given, it was given without due diligence and it was given without due care, so that it gets covered under section 66 subsection 2. But simply saying that advance is given, that is not fraudulent. Simply saying that the material was sold and the money is not recoverable, that is not a fraud. We have to
Hmm.
show that the other party to whom the material was sold or to whom the advance was sold. One, that it was not a business transaction. It was not related to the business of the CD. The due diligence was not conducted. Unnecessary credit was extended to a party who doesn't have any creditworthiness. Those has to be proved.
Okay. Then we have a question that if CRP is stayed by NCLAT and time lapsed for more than 2 years and finally stay is withdrawn, what will be look back period? Original date of CRP initiation
Original
or
date of
lifting?
CIRP. The
Yeah,
original date of
original.
CIRP will continue.
Yes. Then we have a question that the twilight zone has not been defined anywhere. However, the look back period has been defined. Given that Section 66 transactions may be concealed beyond the look back period, should the RP liquidator review beyond 2 years? Of course, with 66, we go back to 5 years, 7 years, even 10 years in some cases, depending on when the company was last operational or when did it had some operation. We go back in time. So that's important.
But see, when we see the section 66, subsection 1,
Hmm.
it has got nothing to do with the twilight zone.
Hmm.
Section 66, subsection 1 is simply saying that the transactions business of the corporate debtor was being conducted in a fraudulent manner or to defraud the creditors without any kind of twilight zone. Section 66, subsection 2, which talks about due diligence, due care, protection of the assets, that actually is giving some more responsibility to the directors of the company and to the partners of an LLP, that in case you ought to have known that there are no reasonable, there is no reasonable possibilities of avoiding CIRP initiation, then you need to be more careful, you need to be more diligent. So section 66 subsection 2 is related to twilight zone. Section 66 subsection 1 is not related to twilight zone. In case of a transaction which happened 4 years back, when the company accounts was completely okay, 5 years back, for 6 years back, when there was no NPA, when there was no default, and the company was growing, in that period, if a transaction is conducted without due diligence, probably that will not be covered under section 66 subsection 2. This is what I am trying to say. Section 66 subsection 1 is different, but the twilight zone is only when out to have known. So twilight is not defined, but otherwise, in case of, if we see internationally, when we say this word is very popular, that we see twilight zone as a dictionary meaning is that when we know that sun has already set for the day, but there is still some light. So everyone is very sure that now after this there will be dark. And then that is the period when you know that it has to be dark now after that. That is the period which is called twilight zone, that when you know that it will be now dark, absolute dark after some time, then whatever the transaction you do in that particular period, now those are the transactions which are called twilight zone. So that can be from the day the account becomes NPA, that can be day when there is any application is filed, that can be the day when the SARFAESI action was taken. So that is the date when the company actually would say that now it is very difficult to save the company from the clutches of the creditors.
Then there's a question that whether an action can be taken against independent directors or professional directors who were directors when fraudulent transactions took place. To my understanding, independent directors and professional directors can be held liable only with respect to the compliances that they were supposed to ensure in the board meetings. They are not responsible beyond those compliances. What is your view?
It is to be seen whether the independent directors had the knowledge of these fraudulent transactions or fraudulent businesses, or it is to be seen whether any of these transactions had actually got the approval of the board. It is to be seen whether these transactions were reported to the board or not. In case it is reported to the board, in case the transactions have actually the approval of the board, then of course the independent directors are also responsible, because they are also because section 66 subsection 1 says that any person who has the knowledge of such transactions would be held responsible. So we actually have to see whether they actually, were there any circumstances that they had the knowledge of this transaction or these transactions? Then they will be held responsible. That only under section 66 subsection 1 and also in section 66 subsection 2, in case they have not taken care of the due diligence of a particular transaction which was approved by the board.
Then we are saying that can the expected realization from Puffit transactions or Puffit suits be sold in private sale as NRRA?
The NRRA needs stakeholders consultation, and it cannot be sold without stakeholders consultation committee's approval. Secondly, NRRA also has to get the approval of adjudicating authority. So two approvals are required: one, stakeholders consultation committee, and the second is NCLT. So it can be through auction or it can be through private treaty, because see, the amendment that we have seen the amendment on 12th of February 2024. In this case, the private sale is possible with the approval of the stakeholders, and now even the failed auction condition is also removed. Failed auction, this one condition was for private sale that there should be a failed auction, and the private sale should be more than the reserve price of a failed auction. So though that condition has been removed, now the private sale is possible, and it is possible with the permission of stakeholders and also with the permission of NCLT.
Right. Then if the determination is made under section 66(2) and if a board has 10 directors, how the contributions are to be made by each of them equally?
That is not something which is covered. So when the adjudicating authority will pass an order, they will it will depend upon the pleadings from the respondents. Some respondents might say that I'm only having 4% share. Somebody say that I have more share. So it will be as per the directions of the adjudicating authority while passing this order against all the respondents.
Would write-off of a genuine long-term supplier, write back, I think, is what they mean. Long-term suppliers would be considered as fraudulent. No effort has been made to recover such money because the suppliers were important and big to the company to maintain coordinate. I think we're talking about write-off of long-term advance given to long-term suppliers.
Yes. No, not
So
at
here,
all. Write-off of a
liabilities will be written back. The write back of a liability which is payable will not be any fraudulent intent.
yes.
It cannot be. So it has to be, I believe, advance given to the suppliers. In case you write it off, then can you say that it is fraudulent? Because maybe you have given the advance, not booked the purchases from that
I
advance.
have
Maybe
already
you have,
said,
yeah.
when we write off a receivable, then it is not a fraud. What we have to see, whether this party to whom the sale was made was a genuine party, whether the decision of the directors to extend credit was genuine or it was without a due diligence, without due care. That is what to be seen. If it is without extension of such credit is without due diligence, without due care, it gets covered under section 66 subsection 2. If it is otherwise, transaction is happening with a fake party, with a dummy party, then it is covered under section 66(1) also.
Right. Then we have a question from Gulshan Gupta ji that the Gluckridge judgment of SC says that the action under section 66 cannot be initiated against third party, whether a party with whom transactions were carried by CD can be considered as third party, and such party cannot be proceeded with under section 66.
The act is very clear, Ankit.
Yeah.
Section 66(1) is different, section 66(2) is different. Section 66(1) says any fraudulent transaction and any party who has the knowledge of such transaction can be proceeded against, and the order can be passed against them, and they can be made as contributories to the assets of the company. As far as this due diligence is concerned, a lack of care, negligence, that is only against the directors and the partners.
Then Animesh ji is asking that in some cases where 4366 are clubbed, can all the puff applications be in one application? I think that there is a requirement for these to be separate applications. These applications have to be in separate applications before the adjudicating.
Yes, I think Anuj Jain judgment, which came in 2020, and before that, everyone filed a combined application. In that Anuj Jain judgment, probably it was February 2020. It was held by Honorable Supreme Court that for Section 43, there are different kind of evidences are required. For Section 45, different kind of evidences are required. And for Section 66, different kind of pleadings are required. Therefore, all these applications should be made separately. But all those applications which were earlier made by us, the courts are passing the order. NCLT is passing order as a combined order for all Section 43, 45, 50, and 66.
Cash transactions which are part of a business practice can be termed as fraudulent. I think yes, again, if it is a regular process that can be justified from the past practice, then we can't say it is fraudulent. But any cash which was collected by the company which has not been deposited, of course, it is missing. Yeah, I think that's a fraud that you can talk about.
Yes, certainly. If a cash transaction is not reported in the books of account, if the cash is not deposited in the books of account, then it is a fraudulent transaction.
But at the same time, in case the business used to sell in cash and the cash is deposited in the accounts, I don't think that will make for any fraudulent application.
Absolutely. Absolutely.
So in some case, in some transfers, if some transfers were made to third parties, related parties who are not part of the business, and subsequently they paid off more than whatever is transferred.
So if the transaction is made and the money came back, then
Then I
maximum
don't think
somebody can say that this the interest which was being paid to the banks. So this is there is a transaction to related parties. So that's a loss. But then in case there is a business intent, there is a business objective, then that also is acceptable. But in case there is no business intent, there is no business synergy, there is no agreement for any kind of business promotion, then that simple part of loss of interest can be considered as intentional defrauding the creditors of the company.
Then Raviji is asking, in case promoter pays some of the creditors who are more pressing but ignores other creditors, and CRP commences within 1 year, will it be wrongful preference? So if the payment is being made for current dues, or rather for the business to function, then I believe we can easily say that this was paid as part of the business process, part of doing business. But in case some old dues are being paid, or maybe the dues were paid for the promoter's own companies or group companies or related parties, that we can say is a preferential transaction as compared to the secured lenders that might have the better preference.
So in case, see, when we discussed Section 43 at large, maybe on our 95th episode, it was very clearly deliberated that in Section 43, the pressing reason is not to be taken as an excuse. One, that the payment has been made to an antecedent creditor, an existing creditor, and that payment has actually made him as beneficial as compared to the other creditors. So pressing nature or a court, other than a court order, of course, but I think that has already been explained. So what is ordinary course of business is, in case we are making purchases, sales regularly, that is an ordinary course of business. I have got an order where there are many bankers, but one bank is unsecured and the interest is very high. So the company continued paying to that particular small bank the monthly installments. Then the bench said that it is ordinary course of business. However, when we see the judgments for Section 43 from Honorable Supreme Court, the Supreme Court says that any reason cannot be pleaded for Section 43 transactions. So we are filing an appeal against that order.
So So next question is from it says whether a creditor is filing application under rule. Let's skip this. Forensic audit standards, whether they apply to transaction auditors. I think forensic audit standards which have been issued by the institute are applicable on the members of ICAI for any assignment that they take up. And transaction audit, whether they apply or not, if somebody says that, okay, chartered accountant has done a transaction audit, has not followed those standards, maybe there can be a possibility of any formally a complaint, but then that's my understanding of these issues. I'm not sure if these standards themselves say that they are not mandatory but directory.
No, I think it is only the standards. Standards are saying because they are not even naming this as a forensic audit standard. They are actually saying investigating accounting.
Forensic audit investigation, investigative accounting standards. Yeah, I think that's the name.
Yeah.
Then I think I've taken care of all the questions. And again, a question that if the transaction audit report is full of disclaimers and the application is filed based on that transaction audit report, can that be resisted by the promoters? So disclaimers which are mentioned in the transaction audit report, I think it is the duty of the RP to justify that those disclaimers with respect to pending information, lack of information is because the promoters themselves have not shared that information, because I think those are the disclaimers that will be, of course, there. Other than that, if there are any general disclaimers which are not pointing out to lack of information or certain limitation for the transaction auditor to work on the matter or work on the mandate given to him, then those disclaimers should not be given by the transaction auditor or not be accepted in the report by the RP. But if any disclaimer is on basis of pending information or lack of information, RP must have documents with him saying or talking about how he tried to get those documents from the promoters, but they themselves didn't share that. Example, in case we say that books of accounts are not available with the RP and the books of accounts have not been given by the promoters. Now, in that case, the transaction auditor will write that when I did the audit, I was not given access to the books of accounts, and therefore my observations are based on, let's say, the bank statements provided to me. But that disclaimer, the RP will have to say or justify that he asked for the books of accounts and it was not provided to him by the management.
So see, presently the respondents are saying, first of all, that if there is an applicant in the court should consider all the applicants on similar footing. The RP or the liquidator should not be given any additional advantage that if he is not able to provide substantial documents against in favor of the allegation that he's putting, then the application should be rejected. And the courts are also taking this opinion because the courts are considering them as an independent. They are not considering them as further investigating agency. They are not considering that if the RP was not getting information or the RP was not provided information, then it is our duty to get information from the promoters or from the other parties. That court is not considering. Court is saying that if you don't have the documents, we actually will be giving our decision based on the documents, based on the evidences that you submit. Therefore, this is something that we are trying that in some situation that in fact we have given the feedback also that the applications, PUFE transactions, even if the information is limited, the information was not provided, the orders of section 19 subsection 2 were not complied with, then the benefit should not go to the contributories or benefit should not go to the like people who have done the wrongful trading. So that is what is presently a missing link because see, the promoters are actually getting advice that not providing information is better option as of today.
Right. So I think we're through with our time, and
although there are many other judgments, but as I said that these judgments are depending upon these how it has been pleaded and reported. So we should actually try to see the judgments which actually finally come from NCLAT or a detailed judgment which may come from Supreme Court. Then only we would be able to finally conclude what kind of transactions are fraudulent and what kind of transactions are not. Thank you very much. And it is always a pleasure. And we always be happy when the audience is huge in number. Thank you.
Thank you, everyone. Thank you.